All right, let's talk about gold. It's so much more than just a shiny metal. I like to think of it as a global fever chart. It tells us how the world is feeling, economically speaking, and it really taps into our deepest fears. So let's dive in and see what's really going on. And this is where things get weird. It's the central paradox of gold, right? Just think about it for a second. It pays you zero interest. It doesn't generate any profit. There's no balance sheet you can look at. So why on earth, for thousands of years, have we put so much trust and so much value into this rock? So why does gold still matter? Well, the answer really lies in its unique dual identity. It's got this split personality. There's a constant tug of war between what gold physically is and what it financially represents to all of us.
And its dual identity is absolutely key. See, on one hand, it's a physical commodity. We use it for jewelry, it's in our smartphones, and its supply is totally limited by what we can literally dig out of the ground. But on the other hand, it's a financial asset. It's that go-to safe haven when things get chaotic, it's a core reserve for central banks, and it exists completely outside of any single government's policies. This constant conflict is the engine that really drives its price.
Okay, so now that we get its identity, let's decode what's actually moving the price up and down. We can pretty much boil down all those complex market forces into two key, kind of opposing drivers. I like to call them the slow burn and the sudden shock. The slow burn, well, that represents those deep underlying economic tides, the things that shift over months or even years. The sudden shock is exactly what it sounds like: a crisis, a conflict, some big event that sends investors running for safety right now. So for the slow burn driver, the most crucial concept to wrap your head around is real yields. In simple terms, this is just the return you get on a super safe investment like a government bond, but after you subtract the effects of inflation, it's what you're actually earning at the end of the day. And this is where gold really has its moment. When those real yields are super low or even negative, which means your safe investment is literally losing purchasing power to inflation, gold suddenly looks incredibly attractive. Why? Because while gold pays no interest, it also doesn't get eaten away by inflation in the same way. It becomes a reliable store of value when other options are failing you. And then you have the sudden shocks. History gives us a really clear pattern here. In 2008, when the whole banking system was on the brink of collapse, people fled to gold. In 2020, with the pandemic creating massive global uncertainty, gold just soared. And in 2022, when major geopolitical conflict broke out, it went right back to its ancient role as the ultimate safe haven. These shocks are incredibly powerful, immediate drivers of its price. Okay, so we've got these forces, the slow burns and the sudden shocks. But who are the actual people and institutions behind the price, the ones responding to these events? Let's take a look at who's really moving the market. You can really break it down into three main groups. First, you've got investors. That's everyone from you and me to massive hedge funds, and they're all trying to either preserve their wealth or speculate on the price. Then there's the industry, the miners and jewelers who handle the physical supply and demand. And finally, you have the most powerful players of all, the central banks. And they are playing a very different, very long-term game of national stability. But over the last decade or so, the behavior of one of these groups has completely rewritten the rulebook for gold. I'm talking about a fundamental shift, and that group is, you guessed it, the central banks. I mean, just look at this chart. This shows the dramatic shift. For years, central bank buying was steady. It just kind of provided a solid floor for the price. But starting around 2022, their net purchases just exploded. We're talking more than doubling, to over 1,000 tons a year. This isn't just about diversification anymore. This is a huge strategic move away from assets like the US dollar, and it's creating a massive, consistent new source of demand for gold. So all of this, the new role of central banks, the constant threat of shocks, it really begs the question, what does the future actually hold for this ancient asset in our increasingly digital world? And this brings us right to the big debate of our time: old scarcity versus new scarcity. Gold scarcity is physical. It's a chemical element, and our trust in it is built on millennia of history. Digital assets like Bitcoin, well, their scarcity comes from algorithms, and their trust comes from network security. But their behavior under stress couldn't be more different. When a real crisis hits, gold has historically been a stable store of value, while digital assets have often shown just extreme volatility. And that leads to a really powerful concluding thought here. As we innovate with programmable money and all these tokenized assets, the financial system still seems to need an anchor, a final reference point that is real, tangible, and something that can't be changed with a line of code or a quick policy decision. Which really leaves us with this one big question. In a financial world that's becoming more and more abstract, more digital, what's the value we're willing to place on something tangible, on time-tested trust? Maybe that's the ultimate driver of gold's price. What is that trust truly worth? Definitely something to think about.